Good afternoon, ladies and gentlemen. Today's JSE topic, using fundamental analysis to build your portfolio, as I'm sure it will be valuable to all of you that are busy with the JSE challenge. So let's just get into the presentation. So what is fundamental analysis? Well, it involves looking at quantitative and qualitative information to gain insight on a company's future prospects. When we talk about quantitative information, we're talking about financial aspects, looking at your income statement, your balance sheet, and your cash flow statement. And qualitative is more the macro and economic aspects and the environment that the company operates in. The primary assumptions of fundamental analysis. The main one is that the market is inefficient and the share price of a company does not fully reflect its intrinsic value. Now, the intrinsic value is what the company is worth. So in the long run, the assumption is that the long run efficiencies will be corrected and a company's share price will reflect its underlying fundamentals. So it would move towards its intrinsic value. Therefore, fundamental analysis attempts to determine a company's intrinsic value based on the underlying factors that affect the company's actual business and its future prospects, to determine if it's trading at a discount, where you're getting an opportunity to buy, or at a premium, where it gives you a signal that you should sell the stock. So when we look at fundamental analysis, we can look at it from the top-down approach or the bottom-up approach. So the top-down approach, we look at the macroeconomic analysis first. What is happening in the local economy? The GDP, inflation, the exchange rate, what's happening with interest rates. And then from there we go down to industry analysis, where we'll discuss Porter's 5 forces later. When we've done industry analysis, we will go down to company analysis, where we're looking at specifics of a company, the management of the company, profitability, and growth expectations. So the top-down approach is very qualitative, and it looks at a macroeconomic picture going down into the sector or industry growth. Whereas a bottom-up approach is more quantitative, where we're looking at company analysis. We're trying to identify companies that have got good prospects based on reasonable valuations, or they could have a history of earnings growth, or they could have future growth expectations that are quite good. And from there on, we'll look at the industry to see what is happening in the industry that makes them contrarian, and then at macroeconomic analysis. So the qualitative factors, the industry factors that we will look at when we look at a company based on fundamentals. We look at the customers. What is your customer base, and is it a long-standing relationship that you have with these customers? And are they, is it difficult to gain them, and how easy is it to lose them? And your market share. And with market share, we talk about your economic moat. Your economic moat is the reason for your business. It is why the business will be sustainable and what differentiates you from any other business or any other business model. And then we also look at economies of scale. If you are a manufacturing company, is there economies of scale that gives you bigger market share than your competitor? We also look at industry growth. If you look at the telecom, the mobile telco market that is currently highly saturated, what is the potential for growth going forward for the industry in which this company operates that you're looking at? And competition is also important. What is your barriers to entry? We will look at Porter's 5 forces with regards to that as well. And then regulation. Would there be any changes in legislation or regulation that could potentially impact on an industry and make it less secure, or make it or turn it around that it could actually benefit that industry? If you're looking at carbon taxes, manufacturing companies that produce high carbon taxes, they could be impacted severely if that regulation should go through and be implemented, and that could affect the earnings of industry and companies.